Hi, I am Wan Suhaimie, Head of Economics at Kenanga Research. The government had just announced its proposed federal budget for 2017. Here's the quick take. The 2017 budget starts cautiously optimistic of 2017 prospects, stronger domestic demand, particularly from private sector, consumption and investment, is expected to drive stronger growth in 2017. The external sector is expected to remain resilient, though downside risk from external headwinds, uncertainty in the global growth prospects and financial market volatilities remains a consideration. The 2017 growth forecast of 4 to 5% from 4 to 4.5% in 2016 reflects some growth upside in 2017, though the wider range suggests that this optimism may be tempered by high uncertainties in the global economy. Is the economic growth target achievable? We believe it can. Improvements, albeit restrained, in business and consumer sentiments will help sustain Malaysia's domestic-led growth. Given the ongoing fiscal consolidation and the mildly expansionary 2017 budget, the public sector will likely play a more subdued role in stimulating the economy in 2016 and 17. Private expenditure is expected to expand at a faster rate of 6.2% in 2017 and from 5.9% in 2016. This is complemented by a corresponding faster growth of private investment backed by improving sentiments. However, substantial downside risks remain, especially in the context of China's tepid growth, volatility from Eurozone, especially from the Brexit process, and the future of global oil prices, among others, may place a damper on overall growth. Fiscal consolidation remains a prevalent theme in the 2017 budget, with the reprioritization of expenditures under both operating and development expenditure. Despite modest growth in operating and developmental expenditure, subsidies and social assistance and housing social expenditure is expected to decline in 2017. Revenue growth is projected to recover to 2015 levels, supported by increases in corporate income tax from improving economic conditions, modest recovery in oil revenue, and higher GST collection. Expenditure growth continues to be modest, consistent with fiscal consolidation objectives. I believe the marginally lower fiscal deficit target of 3.1% for 2016 and 3% for 2017 is attainable unless the external macro environment deteriorates. Will this be an election budget? As in the previous budget, the common theme for 2017 proposed budget is to focus support towards the low-income group, or the bottom 40%, or B40, and to a certain extent, the middle 40% income group, or M40, along with small business owners via grants, access to capital, or direct cash transfer. Directed assistance to these groups minimizes the need for trickle-down approach. This coincides with the possibility of 2017 being an election year. Higher development expenditure earmarked for upgrading physical infrastructure, i.e. roads, transport system, telecommunication and energy infrastructures to mainly benefit the rural areas is also indicative that the government would all call for an election soon. To sum up, the government's budget is tight and economic growth depends on favorable external and domestic factors. Hence, it's still going to be a tough year ahead. Stay tuned for future macroeconomic updates. I am Wan Suhaimie at Kenanga Research. Thank you for listening. Have a great week ahead.